You are about to be quietly locked out of your own retirement wealth, and you have exactly until December 31st of this year to stop it. Because of a hidden clause in the newly enacted tax laws, if you make over a certain amount of money, your employer is legally required to freeze a massive portion of your 401k contributions unless one specific box is checked in their administrative paperwork. This is not a drill, and this is not a prediction about the distant future. We are sitting right here in the middle of 2026, and a massive legislative collision has just occurred behind closed doors. Last year, the passage of the One Big Beautiful Bill Act permanently locked in our tax brackets, which sounds great on the surface. But when you combine that with the IRS's Secure 2.0 Act regulations that went fully live on January 1st of this year, a trapdoor opened under millions of middle and high-income Americans. I spent my entire life reading the grueling, microscopic fine print of the IRS tax code so that you do not have to. And what I found buried in the new rules for 2026 is deeply concerning. Today, we are going to unpack exactly what the government just changed regarding your catch-up contributions, how a new mandatory tax treatment is going to violently shrink your take-home pay, the dangerous illusion of the brand new super catch-up allowance, and finally, the exact move you must make with your HR department before this year's window closes permanently. For decades, the American retirement system has operated on a very simple, very predictable premise. You put your money into a 401k on a pre-tax basis, you lower your taxable income for the current year, and you let that money grow uninterrupted for decades until you retire. It was a fair trade. You gave the economy your capital, and the government gave you a tax break today. But the government has a problem right now. They are facing unprecedented deficits, and they can no longer afford to wait 20 or 30 years to collect taxes on your income. They need the money right now. And so they went searching for the largest pool of untapped revenue they could find, and they found it sitting in the retirement accounts of older, higher-earning Americans. This brings us to the first major shift you need to understand, which is the foundational reality of our new tax code. In July of 2025, the government passed the One Big Beautiful Bill Act, which finally gave us certainty by making the 7 federal tax brackets permanent. Those brackets are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. This legislation also increased the state and local tax deduction limit to $40,400 for most filers through 2029, and introduced a brand new $6,000 bonus deduction for seniors over the age of 65. On the surface, this sounds like a victory, but permanence in the tax code is a double-edged sword. Because the government locked in these brackets, they knew exactly how much revenue they were going to lose. To make up for that lost revenue, they activated a delayed provision from the Secure 2.0 Act that specifically targets the exact people who are trying to aggressively catch up on their retirement savings. This is the hidden trapdoor, and it is the single most urgent threat to your wealth right now. The IRS has fundamentally altered the rules for catch-up contributions in 2026. If you are 50 years old or older, you are allowed to contribute an additional $8,000 to your 401k on top of the standard $24,500 limit. That brings your total potential contribution to $32,500. For years, you could put that entire amount into a traditional pre-tax account, slashing your taxable income and saving yourself thousands of dollars in immediate tax liability. But as of January 1st, 2026. If your wages from your employer exceeded $150,000 in the previous year, you are officially classified by the IRS as a high earner. And if you fall into this category, every single penny of your catch-up contribution must be made as a Roth after-tax contribution. Let that sink in for a moment. You no longer have a choice. The government has stripped away your ability to choose how your own money is taxed. If you earned over $150,000 in FICA wages in 2025 from your current employer, the IRS mandates that your entire $8,000 catch-up contribution goes directly into a Roth account. You will pay top marginal taxes on that money right now before it ever hits your investment portfolio. But here is where the situation turns from an annoyance into an absolute emergency. Ask yourself this: does your employer actually offer a Roth 401k option? Industry data shows that a staggering number of small and mid-sized employers still only offer traditional pre-tax 401k plans. And under the new Secure 2.0 rules, if your employer's plan does not have a Roth option, high earners are completely banned from making any catch-up contributions whatsoever. You are entirely locked out. Your wealth-building machinery freezes. If your human resources department does not amend their plan documents by the end of the 2026 plan year to officially include a Roth feature, the administrative record keeper will reject your money. You will lose the ability to shelter that additional cash, and that contribution space will be gone forever. You cannot roll it over to next year. You cannot ask for a do-over. over. Once the 2026 window closes, that lost compounding growth is permanently erased from your financial future. The mechanics of how the IRS calculates this $150,000 threshold is a bureaucratic nightmare. The threshold is based specifically on your prior year FICA wages, which are located in box 3 of your W-2. It does not matter what your base salary is on paper. It matters what was subject to Social Security payroll taxes last year. If your base salary is $140,000, but you received a $15,000 year-end bonus in 2025, your box 3 wages hit $155,000, and you are immediately trapped in the Roth mandate for 2026. This brings us to the most dangerous illusion in the new tax code, a provision that looks like a gift but functions like a financial landmine. The IRS has introduced a brand new super catch-up contribution specifically for people who are age 60 to 63. If you fall into this narrow 3-year age window in 2026, you are no longer limited to the standard $8,000 catch-up. Instead, you are legally permitted to contribute up to $11,250 as a super catch-up. When combined with the standard limit, this allows you to pump a massive $35,750 into your 401k this year. When this was announced, financial media celebrated it. It sounded like the ultimate tool for late-stage retirement planning, but they completely missed the math. Because of the Roth mandate, if you make over $150,000, that entire $11,250 super catch-up must be made with after-tax dollars. Let us run the real-world numbers on this. If you are single and making $200,000, you are sitting squarely in the 32% permanent federal tax bracket under the new One Big Beautiful Bill Act. If you elect to make the maximum super catch-up contribution, you are forced to pay 32% federal tax plus whatever state tax you owe on that entire $11,250 right now. You are literally volunteering to pay thousands of dollars in immediate taxes out of your paycheck just for the privilege of saving your own money. I am going to reveal the exact step-by-step move you need to execute with your HR department before the 2026 deadline to legally bypass this trap and protect your wealth. But first, you have to understand the severe cash flow crisis this is about to cause in your household. For decades, we have been taught to automate our finances. Set it and forget it. You pick a percentage of your income to defer into your 401k, and you let the payroll system do the rest. But if you have your 401k contribution set on autopilot in 2026, you are going to experience a violent shock to your take-home pay. Because Roth contributions do not lower your taxable income, your tax withholding is going to fundamentally change. The money going into the catch-up bucket is no longer shielding your paycheck from the IRS. If you were aggressively utilizing the traditional pre-tax catch-up in 2025, and you let the system automatically flip you into the mandatory Roth catch-up in 2026, your net pay is going to dramatically shrink. The taxes will be pulled from your gross income immediately. People who meticulously budget their monthly expenses based on their historical take-home pay are going to find themselves short on cash simply because they did not manually intervene in a tax code change they knew nothing about. But the tax code is written by politicians, and politicians always leave themselves a back door. There is a massive structural loophole built into this new mandate that you must be aware of if you have multiple streams of income or if you own a business. The IRS explicitly states that the Roth catch-up mandate only applies to employees whose prior year wages were subject to FICA taxes from the exact employer sponsoring the plan. What does this mean for you? It means that if you changed jobs on January 1st, 2026, your FICA wages from your new employer in the prior year were mathematically zero. Therefore, even if you made $500,000 at your old job in 2025, you are not considered a high earner by your new employer's plan for the 2026 calendar year, and you can continue to make traditional pre-tax catch-up contributions. Furthermore, if you are self-employed, a partner in a firm, or a business owner operating with K-1 income or Schedule C income, you are completely immune to this rule. Why? Because the IRS does not consider K-1 distributions or Schedule C profits to be FICA wages in this specific context. You could be making millions of dollars as a business owner utilizing a solo 401k, and you can still take the full pre-tax deduction for your catch-up contributions. The government has essentially created a two-tiered system, one where high-earning W-2 employees are punished with immediate taxation, and another where business owners and partners get to keep their tax shelters completely intact. This brings us to the absolute most critical part of our discussion today. The 2026 window is rapidly closing, and inaction is no longer an option. You cannot rely on your employer to figure this out for you. Human resources departments across the country are currently drowning in the administrative chaos of trying to comply with the Secure 2.0 Act. They are terrified of failing IRS non-discrimination tests, and they are struggling to update their payroll software to automatically differentiate between employees who made $149,000 and those who made $151,000. Here is the exact non-negotiable sequence of moves you must make right now. I call this the 2026 Compliance Audit and Contribution Resequencing Strategy. Step 1. You must perform an immediate audit of your 2025 W-2 form. Do not look at your final pay stub. Pull the actual W-2 document and look strictly at box 3, which lists your Social Security wages. If that number is exactly $150,000 or lower, you are safe for this year. You can proceed with traditional pre-tax catch-up contributions, but if that number is $150,001 or higher, you must immediately contact your Human Resources Director or your Benefits Administrator. Step 2. You need to ask them one highly specific question. You must ask, has our 401k plan document been formally amended to permit Roth contributions, and have you instituted a deemed election protocol for high earners? A deemed election is an IRS provision that allows an employer to automatically recharacterize your traditional catch-up contributions into Roth contributions once you hit the regular $24,500 limit. If they stare at you blankly, or if they say they are still working on it, your wealth is in grave danger. You must respectfully but firmly demand that they update the plan with their record keeper before the end of the year. Remind them that if they fail to add a Roth option by the end of the 2026 plan year, the IRS legally prohibits them from accepting catch-up contributions from any high earner in the company. You are literally advocating for the preservation of your own retirement space. Step 3. You must completely resequence your contribution strategy for the remainder of the year. If you are forced into making Roth catch-up contributions, you need to deliberately manage the tax hit. Since you can no longer use these catch-up contributions to lower your modified adjusted gross income, you need to find tax deductions elsewhere to balance the scales. This is the exact moment to maximize your health savings account, or HSA, if you have access to one. An HSA is the most powerful tax shelter in existence, offering a triple tax advantage. By maxing out your HSA, you can forcefully lower your taxable income to offset the painful sting of the forced Roth catch-up. Furthermore, if your employer's plan allows for it, you should immediately investigate the mega backdoor Roth strategy, because the combined employee and employer contribution limit for 2026 has been raised to $72,000 or even higher if you are making catch-up contributions. You may be able to make significant after-tax contributions beyond the standard limits and immediately convert them to a Roth. If the government is going to force you into a Roth framework anyway, you might as well weaponize it to your absolute advantage and pack as much money into that tax-free growth environment as mathematically possible. Finally, you must sit down with your CPA or use a tax calculator to adjust your W-4 withholding right now. Because your take-home pay is going to artificially drop when those mandatory after-tax Roth catch-ups hit your payroll, you need to ensure you are not over-withholding on your regular income taxes. You do not want to give the government an interest-free loan at the exact same time they are forcing you to pay taxes on your retirement savings up front. Adjust your allowances to free up cash flow in your monthly budget and redirect that capital into your investments. Let us summarize exactly what we have covered today so that you have a crystal clear roadmap moving forward. First, we established that the 2025 One Big Beautiful Bill Act permanently locked in our federal tax brackets, meaning you can no longer just wait for rates to change. You have to plan within the current permanent reality. Second, we exposed the secure 2.0 trapdoor. If your Box 3 FICA wages from your current employer exceeded $150,000 last year, the IRS legally forces you to make all of your catch-up contributions as after-tax Roth contributions this year. Third, we highlighted the profound danger of employer negligence. If your company's retirement plan does not explicitly offer a Roth option, you are strictly prohibited by law from making any catch-up contributions at all, entirely freezing your ability to maximize your savings. Fourth, we broke down the illusion of the age 60 to 63 super catch-up, proving how the massive $11,250 limit can actually trigger a devastating and immediate tax bill if you are forced into the Roth mandate. And finally, we outlined the specific compliance audit you must perform with your HR department today to force a plan amendment before the 2026 window closes for good. This is an incredibly complex and frustrating shift in the American retirement system. The government has essentially moved the goalposts while the game is still being played, and it is up to you to protect your own wealth. Do not let bureaucratic red tape lock you out of the compounding growth you deserve. Now, I need to hear directly from you. Go down to the comment section right now and tell me your experience with your employer regarding this new Roth mandate. Has your HR department actually communicated this massive change to you, or are they completely in the dark? Comment your experience below so we can see exactly how companies are handling this transition on the ground.